Hello, good evening, and welcome to Unacademy IAS, a one stop destination for all the English medium civil services aspirants. Welcome to session 3 of 12th class standard Maharashtra board coverage of the book Indian Economy. Now, before I start, please do let me know, am I audible and visible for all of you? Those present in the session, am I audible and visible for all of you? Thanks a lot. So just to recap what we have done so far, I've taken two sessions. Session number 1 or the class number 1 was on national income chapter. Class number 2 that was done yesterday, there was coverage of one more chapter. Today we are going to cover the third chapter, money and capital market. Before I start, here is a very important announcement. If you are aiming of acing the civil services exams 2027, you need to have a holistic coverage of the static portion, the right coverage of the current affairs. You need the correct reading material, and also you need to attempt multiple prelims as well as mains test series. You'll get access to all of this in a structured manner once you enroll into our courses, which is priced at 18,999 for today. Just a reminder, after the midnight, the pricing will be changing to 19,999. So those who are interested in enrolling, check out the details by clicking on the link provided in the description below. And whatever is the price mentioned in the website, use the code IAS English to receive the discount. Now let me start the discussion. Financial market. Now, what is the basic idea of a financial market? In the financial market, essentially what happens is the financial instruments are traded. The financial instruments are traded. So it is a market where financial instruments are issued and traded. Now, what do you mean by financial instruments here? In the market, there are two sides. One side, it has money which they want to invest in the market. And on the other side, we have the issuers of the instruments, the issuers or the sellers of the instrument, which want to issue these instruments and get the money from the market. Let me give you one example here. There are certain instruments which are issued by the government by the name government securities. Government securities. The government securities can be of short duration. The government securities can be of short duration, and the government securities can be of longer duration as well. And what do I mean by short duration and long duration here? Whenever an instrument will have a maturity period of up to 1 year, it is called as a short duration. And when the instrument will have a maturity period of more than 1 year, this is basically the long duration. For example, the government securities which are issued in the market by the government, some of these instruments will have a maturity period of up to 1 year, and these are called as treasury bills. These are referred to as the treasury bills. For example, the government issues treasury bills of maturity period 91 days. 91 days. Meaning what? If the instrument is issued today, the instrument will have a validity of 91 days. The government will sell the instrument today, take the money from the investor or the buyer of the instrument today. And after 91 days, the money is returned along, money is given back along with interest to the investor. So 91 days instruments are there. 182 days instruments are there, as well as 364 days instruments are there. These are short duration, hence these are referred to as treasury bills. There are also instruments which will have a maturity period of more than 1 year. We have instruments which will have maturity period of 5 years, which have maturity period of 10 years, 15 years, 30 years, 40 years. Right now, the instrument which has the longest maturity period, which will have the longest maturity period which is issued by the central government, is 50-year duration. 50-year duration. So have a look at this. The government will issue this bond today. These are called as government bonds. So government will issue these bonds today and these will mature after 50 years. Everybody is okay? Now, what is the idea of, right, let's say financial market in the context of using these instruments? Let's say the government will issue these instruments today, will issue the instruments today. I will purchase the instrument. Now, the money will go from my side, the money will go to the government. I will get the instrument. The instrument will come to me, right? And I will hold the instrument, and the money from my hand will go to the government. Let's go back to the definition of financial market now. What is the definition of financial market? It is a market where financial instruments are issued, financial instruments are traded. So, are you seeing the government of India issuing a financial instrument? I am purchasing, now the money will go to the government. So, this is a basically financial market. Now, there are multiple instruments. Do not assume that only government of India will issue the instruments. There are multiple instruments. We will understand them one by one. But before I go forward, have a look at the division in the financial market. Have a look at the two parts of the financial market. Financial market is divided into money market as well as capital market. Money market and capital market. What is essentially the difference? Why do we have two different markets here? Let's start with a very simple example. Imagine we will start a company today, right? Let's say me and you will come together, we will come together, start a company. Now, when this company is started, we will require money for two different purposes. One requirement for money for a company is basically we want the money to take care of the day-to-day operations. To take care of day-to-day operations. Correct? For example, we need money to pay for raw material. We need money to pay for wages for the workers. That is a day-to-day operations requirement. And the second one is we need to spend money to create assets. To create assets. What do I mean by assets here? Let's say we want to establish or set up a new manufacturing facility. We want to purchase machineries. We want to acquire one more company. So essentially the logic here is we need money to create assets. So these are the two requirements of a company. The technical term that they will use is here for taking care of day-to-day operations. If I want to raise money from the market, I go to money market. I go to money market. I'll go to the money market, issue certain instruments, take the money from the money market, and that is for very short duration. That is for short duration. Short duration essentially means up to 1 year. But if I want money for creation of assets, if I want money for, right, let's say purchasing machinery, if I want money for establishing construction of a new manufacturing facility, in that particular context, I go to the market which is called as capital market. I will go to the market that is capital market, where capital essentially means assets. Capital in this context essentially means asset. So for creation of assets, we go to the capital market, borrow for more than 1 year. It could be medium term, it could be long term. Whereas if you want to borrow money, raise money from the market for short duration, you will go to the money market. There is one more technical term used in the context of money market. Please remember that. They will use the term working capital. They will use the term working capital. That is, in order to raise money for working capital, which market do we generally go to? We go to, right, the money market. Working capital simply means the money that is spent to take care of day-to-day operations. Although technically the definition, accounting wise, the definition of working capital is the difference between the current assets and current liabilities. But in a nutshell, what does the working capital simply mean? It is to take care of the operations or the expenditure on day-to-day basis. So for working capital purposes, you go to money market, and for asset creation purposes, you go to capital market. So far the discussion is clear. Those present, please give me the confirmation. So far the discussion is clear. Can we go forward now? Okay, now let me essentially enter into each side of the two markets. Let me start with first money market. Let me start with the first money market. Right? What are the different instruments used under the money market? The first and very, very important instrument used in the money market is repo and reverse repo. Repo and reverse repo. Right? What is a repo and a reverse repo? Under repo, Reserve Bank of India will provide a short-term loan to financial institution such as bank, and will charge a rate of interest on that. I'll repeat the statement. What is repo? Under repo, Reserve Bank of India will provide a short-term loan to a bank and charge a rate of interest on that. So what do you mean by short term here? The short term could be 7 days. It could be 21 days. It could be 14 days. It is entirely decided by Reserve Bank of India. But what is the important point to note? It is a short term instrument. Here the banks will borrow from the Reserve Bank of India for short duration. So everybody is able to understand what is a repo, and by nature when it is a short term instrument, it will come under the money market. What about the reverse repo? What about the reverse repo? In the reverse repo, here is the Reserve Bank of India. The Reserve Bank of India will borrow from a bank for short term. The Reserve Bank of India will borrow from the bank for short duration. Now here bank will give a loan for a short duration to Reserve Bank of India and charge a rate of interest on this particular loan. This is called as the reverse repo. And please remember this, the repo rate is greater than reverse repo rate. The repo rate is greater than reverse repo rate. Is everybody okay? Please do let me know. Is everybody okay with the first important instrument? Will it be always greater? Pradeep is asking, will it be always be greater? Yes, my dear. Yes. Essentially, think of it like this. You take a loan from a bank. You will pay a rate of interest. Bank will collect deposit, essentially borrow money from you. Bank will pay a rate of interest. Don't you think bank, when they will charge a rate of interest to you, right? When the bank will charge a rate of interest to you on the loan given, will it not be greater than the loan? Will it not be greater than the rate of interest that the bank will pay you? Correct? All of you able to understand? You will keep 100 rupees under, let's say, savings bank deposit. The bank will give you 4% rate of interest. You will borrow 100 rupees from the same bank. The bank will charge you 9%. Bank will charge you 10% rate of interest. So that is essentially the logic. Apply the same logic here. Otherwise, what will happen? If the RBI pays more rate of interest rather than earning more rate of interest, don't you think RBI can incur bankruptcy? RBI can, right, basically fall into losses, declare bankruptcy very soon. So please remember, repo rate is greater than reverse repo rate. That is the first important tool. Second very important tool, call money rate or call money market. Call money rate or call money market. What is this call money market? The banks, some of them will have huge amount of cash. And there is another bank, right, or some of these particular banks which will have shortage of cash. Very simple. Sir, how can that happen? Let's assume the current situation. Festival is being celebrated. In some of these particular banks, people will go, they have kept the deposits, right, and they will basically start withdrawing. They will start withdrawing the money. Now, as a result of this, the bank will have shortage of money now. And at the same point of time, there could be one more bank which has a lot of deposits, which has a lot of cash. It has surplus cash, and the other bank is facing shortage of cash. Is everybody able to understand? So in this situation, what one bank will do is, let's assume bank 1 has surplus cash and the bank 2 has a shortage of cash. So bank 1 will give loan for a short duration to bank 2. Is my point clear? Do let me know. Bank 1 will provide a loan, short-term loan to the bank 2. The short-term here could simply means it could provide a loan for overnight purposes, that is only one day, or it can provide loan for more than one day, generally up to 14 days. Generally up to 14 days. So whenever the loan is given by bank 1 to the bank 2 for overnight purposes, this is called as call money. This is called as call money. And when the loan is given for more than 1 days, that is, let's say from 2 days up to 14 days, this is called as notice money. This is called as notice money. And when the bank 1 will provide a short-term loan to the bank 2, it is not free of cost. It is not doing any charity, by the way. Please remember, in the market, any transaction, any kind of assistance, whenever it is provided by these institutions, it is always done with the objective of profit making, in order to generate revenues, in order to earn income. And that is where there will be a rate of interest charged by the bank 1, and that is called as a call money rate. That is referred to as call money rate. Is everybody okay with the first and second tools now? The first as well as the second. Repo, reverse repo, and the call money rate. Right? One bank will lend for a short duration to another bank and charge a rate of interest on the loan. And that is called as a call money rate. And please go back to the basic definition. Money market means short term. Money market is nothing but short term. And whatever instruments you have seen so far, be it repo, reverse repo, call money rate, all of them are essentially the short-term instruments. Let's go forward now. Commercial papers. Commercial papers. What is the basic idea of a commercial paper? Let's say there is an entity or there is a company. Now this particular company has a shortage of working capital. This company has a shortage of working capital. And by nature, please remember this. Lot of companies in India as well as in the global market, lot of these companies generally function on a shortage of working capital. That is the money that is available for them to take care of the day-to-day operations. There is always a shortage. Now here is a company. This company, let's say, has a shortage of working capital. Now it can go to a bank, borrow for short duration. It can go to the bank, borrow for short duration. But when you take a loan from a bank, let's say for a short duration, you will have to pay rate of interest on the loan. Although it is called as a working capital loan, it is not free of rate of interest. The company has to pay certain rate of interest on this particular loan. Now, this particular company in this context may try to use one more type of an instrument to borrow from the market for short duration. That instrument is called as a commercial paper. That instrument is referred to as a commercial paper. This company will now issue a short-term instrument in the market. I will purchase it, you will purchase it. Now, you will pay money to this particular company. They will use the money for a short duration, let's say for 3 months. And after the tenure is over, they will return the money along with interest to the investors of commercial papers. Right? These are issuers of the investors in the commercial paper. So here a company will issue the instrument, short term in nature. It will collect the money from, right, let's say the investors, and upon maturity the money will be returned along with interest to the investors. Right? So everybody is okay. This is basically the concept of a commercial paper. But here is a very important point to note. Can any company, I'll repeat the statement, can any company in India issue a commercial paper? SEBI simply says no. Anybody and everybody is not allowed to issue commercial papers. Because mind you, there will be a lot of these particular companies who are not credit worthy in the market. What if the company is issuing this because it has already incurred losses? What if the company is issuing but there is no guarantee of generating revenues in the coming days to repay the amount that they've collected from the commercial paper? That is the reason, please remember, only those entities which will have very good credit rating. Only those entities which will have a very good credit rating. There is a concept of credit rating. Every borrower in the market, entities I'm talking about, not individuals. Entities who are borrowers, including the government, by the way, they will be given a rating. The rating, such as a triple A, basically suggests that this kind of a borrower is most credit worthy in the market. Right? The borrower who will have the credit rating of triple A, it is the most credit worthy borrower. Meaning what? The risk of giving money to this particular borrower is the lowest. I'll repeat the statement. Risk of giving money to the borrower is the lowest. I'm not saying zero risk. There is no concept of a zero risk in the market. There is always some amount of risk. But how much is the risk? Compared to any other borrower in the market, this borrower will carry the lowest amount of a risk. Whereas, if a borrower is given a credit rating of, let's say, C or D from one institution to another institution, which is the lowest, will vary. Let's say C or D credit rating. Then this particular borrower is most riskiest borrower in the market. If you give a loan to this particular borrower, the risk that you are taking by giving a loan is the highest. So argument is anybody and everybody allowed to borrow by issuing a commercial paper? No. Only the ones with the highest credit rating are allowed to use this particular route to borrow from the market. Everybody is okay? Can we go forward? The fourth instrument. The fourth instrument is certificate of deposit. Certificate of deposit. What is the basic idea of a certificate of deposit? Let me start with a basic idea or a similar idea. All of you heard of fixed deposits? FDs, fixed deposits. In a fixed deposit, what happens generally? You will keep certain amount of money with a bank for a fixed time period. It could be 444 days. It could be 1 year. It could be 5 years. So you will keep certain amount of money with a, right, let's say bank or a financial institution for a fixed duration. But one of the very important features of a fixed deposit is, if I keep the money and the certificate is issued in my name, then the money upon maturity, the amount upon maturity will be given to me. Nobody else apart from me can get the money. Nobody else can get the ownership of a fixed deposit as well. In simple terms, I'm trying to give you the idea of transferability. These particular instruments are not transferable. That is, fixed deposits are not transferable. If I keep FD in my name, upon maturity only I'll get the money. I cannot transfer the FD to your name. The only way the FD can be given or kept in your name is that I will close my FD, then transfer the money to your account. Now one more FD will be decided using your details, or one more FD will be kept using your money from your account using your details. But let's look at one more instrument, similar, not the same. Similar but not the same. Here is a bank, financial institutions. Here is a bank. The bank wants to raise money from the market for short duration. Now the bank will issue the instrument. These are called as certificates of deposits, CD, certificates of deposits. And these instruments will be issued for short duration. These instruments will be issued for short duration, that is 3 months, 6 months, like this. So these instruments are issued. I will pay the money, I will purchase one instrument. But before maturity, if I want to transfer the instrument to somebody else, before maturity, I can wait till maturity. Upon maturity, let's say 3 months are over, I will return the certificate of deposit, I'll get the money. But another way is, if there is already maturity, that is 3 months are over now, right? Or upon maturity, I can submit this instrument, get the money. Before maturity, I can simply transfer it to somebody else in the market and get the money from them. That is transferability feature that is there in the context of certificate of deposit. Is everybody able to understand? Do let me know. Is everybody able to understand? So this is the fourth instrument which is generally used by the financial institutions such as banks, all India financial institutions, etc. to borrow for shorter duration from the market. Okay, what's the duration of commercial papers generally? Kaustav, my dear, it varies. There is no fixed time frame that is given, but generally these will be less than 12 months. The issuers can issue these for 3 months or 6 months, that is depending upon the requirement of the issuer. But please understand, these instruments will have a maturity period of up to 1 year. That's the reason these are classified under the market that is called as money market. Any money limit for commercial paper like minimum or maximum, generally the SEBI will impose certain restriction based on the company, but as an issuer, when you're issuing, these are generally issued in terms of 1 lakhs, 5 lakhs, like this. Okay, let's go forward. Can we go forward? Everybody is okay? Can we go forward? Okay, the fifth instrument within the money market, the fifth instrument essentially is commercial bills. Commercial bills. Right, what is this concept of a commercial bill? Let's start. Let's say I'm a seller in the market, you are a buyer in the market. Okay, both of us are sellers and buyers. Now you will come to me, you will purchase a goods worth 2 lakh rupees from me. What generally happens in the market, that is retail market where we participate, where I and you participate, is I will purchase and I'll pay money. You will purchase and you will pay money. But when it is a transaction between a trader with another trader, a transaction between a company with another company, please remember this, when the transactions are conducted, that is the goods are sold like this, on the same day, payment is not done. Is everybody okay with this? On the same day, payment is not done. There is a concept of a credit cycle. That is, let's assume I am one company who is selling a particular good and you are another company who wants to purchase this good, use it as an input to produce one more good. Now what you will do? You will purchase goods, let's say, worth 5 lakh rupees from me today. Okay, here is me selling the goods worth 5 lakh rupees to you today. Now what you will do? You will purchase the goods, manufacture something else, and you will sell the output in the market. Is the sequence okay with all of you? This is generally how the companies will operate. Now, because you are yet to produce and sell the good in the market, when you purchase the product worth 5 lakh rupees from me today, you will not make the payment today itself. You will tell me that you will make a payment, but after 45 days. Is the sequence okay with you? You are saying, yes sir, I will make a payment. Don't worry, I will make a payment. But the payment will be done after 45 days, not immediately. And please, again I am saying, please remember, this is generally how the companies operate. Do not assume yourself in this particular place that in the retail market it doesn't work, so it is wrong. No, retail market is different. Retail market where we purchase the goods and services, it is different. We purchase and pay the money today itself. But in the market where companies are trading amongst themselves, the traders are buying and selling. This is generally how the system operates. So now you will simply tell me, right, sir, I will make a payment, right? I will make a payment, but after 45 days. So I will basically tell you what is the document. Please give me a document. I should have a document which is a proof, that you owe certain amount of money to me after 45 days. Everybody is okay, right? Please give me a document, issue a document to me which proves that you owe 5 lakh rupees to me. I will come to you. Imagine this is 1st of April. Hypothetically, I am saying, imagine this is 1st of April. 45 days will be April complete and then May. So on 15th May, I will come to you. I will ask you for 5 lakh rupees. But what is the proof that you owe 5 lakh rupees to me? You might simply say, who are you? You might simply ask me that what is the proof that you owe money to me? There should be a document which will prove that you owe 5 lakh rupees to me. So what will happen now? I will draw a document which simply states that you, right, let's say ABC will have to pay 5 lakh rupees to anybody who is owning the document on 15th May 2026. Is everybody okay with this idea? I'll repeat it again. I will simply write a document which says ABC will have to pay 5 lakh rupees to anybody who is holding this particular document or owning this particular document on 15th May 2026. Right? This is basically the concept of a commercial bill. Everybody is okay? Sometimes it is also referred to as a bill of payments, bills of exchange, etc. But argument is very simple. The buyer will have to give a document, basically prove through a document that the buyer owes a payment on a certain day, right? Such amount of payment is owed to one who is holding the instrument. Now, one very important point to note here. I am saying that I am holding the instrument, right? And anybody who is holding the instrument, you will make a payment of 5 lakh rupee to this particular person. Why is the bill drawn like this? Why is the bill wording language done like this? The reason behind this is very, very simple. The reason is, let's say on the 1st of April, I sold goods worth 5 lakh rupees to you. On, right, let's say 20th April, on the 20th April, I need money. I need money for, let's say, payment of wages to my workers, or for the purposes of, let's say, payment of electricity bills, or I need to make a payment for the raw materials that I have purchased earlier. So for whatever reason, I need the money on 20th April. I will come to you. I will ask you to make the payment of 5 lakh rupees. Your reply will be, sir, I made a promise that I will make a payment on 15th May. So till 15th May, I've made a promise. Here is a document. You have the document. So I will make a payment of 5 lakh rupees only on 15th May, not before 15th May. So what is the option for me now? If I'm holding this instrument, now I can transfer the instrument to somebody else, get the money from them, use it for repayment of the, right, let's say the repayment for, right, let's say the workers' salaries or wages, use it for payment of electricity bills, use it for the payment of raw materials that I owe to a supplier to me. Everybody is able to understand the logic here? That is the reason what we do is, when we draw these instruments, we simply say anybody who is holding the instrument will get the payment, will receive the payment. Otherwise, what will happen? Listen to me now carefully. Imagine my name is XYZ, you are ABC. If the bill is written like this, ABC will have to make a payment of 5 lakh rupees to XYZ. Now, I cannot transfer this particular bill to somebody else in the market. I cannot trade this particular bill to somebody else in the market. Because on 15th May, you have promised to pay 5 lakh rupees only to me. Why will anybody else purchase this particular bill now? Correct? Does it make sense to you? Why will anybody else purchase this particular bill? Right? So that is the reason it will say who is the person who owes money. The person who has to pay money, their details are there. How much money? That is mentioned. On what date? That is mentioned. But the one who will receive the money will be the one who is owning this instrument on the due date. Is everybody okay with the concept of a commercial bill now? Do let me know. Everybody is okay with the concept of commercial bill? So these are the most important instruments under the money market that are right present. Now let me shift to the other market. We have taken care of money market. What is other market? Capital market. The other is capital market. Now capital market is divided into two parts. The capital market is divided into two parts. One is called as equity market. And the other one is called as the debt market. The debt market. Equity and debt market. What is essentially the difference between both of them? In the debt market, debt means what? Debt means repayment. Debt is nothing but a liability. Please remember this. Debt is a repayment or debt is a liability. So in the debt market, what happens? Let's say an issuer here will issue an instrument, borrow money for certain duration more than 1 year. Right? Because please remember, debt, essentially the most important component within the debt market is bonds. The most important component within the debt market is bonds. So bonds are the instruments which are issued by the borrower, and bonds will have a maturity period of more than 1 year. So the bonds are issued, the issuer borrows money, and upon the completion of the tenure or the maturity period, the amount is returned to you. The bonds, please remember this, can be issued by government. And when I say government, state government, can they issue the bonds? Yes. Central government, can they issue the bonds? Yes. Even the municipalities, I repeat, even the municipalities can also issue bonds. For example, in the current affairs, you will come across a term such as municipal bonds. So municipalities, yes, they are allowed. States, central governments, all of them are allowed to issue bonds. So one issuer is the government. Second issuer is the corporate sector. Corporate or companies. Second issuer is the corporate sector or companies. For example, private sector companies, they are allowed to issue bonds in the market and borrow. Right? They are allowed to issue the bonds. And the third category of issuers is the government-owned entities. The government-owned entities. Right? There are multiple entities which are owned by the government of India. For example, national highways. Can they issue bonds in the market? Of course, yes. They are allowed to issue bonds. Right? So government-owned entities are also allowed to issue the bonds. And the fourth category who is allowed to issue bonds are global organizations. Global organizations. For example, let's say World Bank. Let's say World Bank. Is the World Bank allowed to issue bonds in the market? Of course, yes. But please understand the distinction here. The government issues the bond either, right? Let's say there is a shortage of money. Shortage in the sense the government has to spend more money compared to how much income they are generating. So there is a gap. There is essentially a gap. For that purpose, the government will issue the bonds. The government might also issue the bonds because they want to promote renewable energy projects. Right? So there are multiple reasons for which the government will issue the bonds. The global organizations such as World Bank, they will specifically issue the bonds in the market because they want to finance for certain projects in particular countries. They want to provide financing for certain projects in certain countries. Private sector will issue the bonds essentially to create assets. Essentially to create assets, to borrow, to create assets and earn profits and use the money for repayment of the bonds. Right? So these are the different type of entities which are allowed to issue bonds in the market and borrow from the market. Now, when you talk about the bonds here, right? Listen to me now. When you talk about bonds, the traditional types, there can be multiple types of bonds, different variations of the bonds. For example, there is one type of a bond which is called as a convertible bond. Convertible bond. What do you mean by convertible bond? Convertible bond essentially means the bond is issued by the issuer, and after certain time period the bond can be converted into another instrument. What do you mean by another instrument here? Let me introduce a part of the equity market now. Equity market simply refers to the market where shares are issued and these particular shares are traded. Is everybody okay? What is equity market? Equity market refers to the market where shares are issued and the shares are traded. Right? What is the meaning of a share here? Share simply means a unit which represents ownership in the company. Is my statement clear? I'll repeat the statement here. What is a share? It is a unit. It is a unit which will represent ownership in a company. Let's say there is a company which has issued 1,000 shares. A particular company has issued, let's say, 1,000 shares. Out of 1,000 shares, if I purchase 100 shares, it will represent 10% ownership in the company. Is everybody able to understand? Do let me know. Out of 1,000 shares, if I purchase, let's say, 100 shares, it represents a 10% ownership in the company. Right? So come back to the discussion. I'll go to the equity market in some time, but let me complete the debt market first. So in the debt market, I was talking about bonds. The first category of bonds is convertible bonds. Convertible means what? The bonds are issued, you will purchase the bond today. But let's say after 2 years, after 3 years, the company or the issuer simply says, now your bond can be converted into another type of an instrument such as share. These are called as convertible bonds. Everybody is okay? These are referred to as convertible bonds. Then there can be non-convertible bonds as well. There can be non-convertible bonds as well. What is the basic idea of a non-convertible bond? Non-convertible bond simply means these are issued as bond and upon maturity these will cease or these will be redeemed as bond. I'll repeat the statement here. These are issued as bond and upon maturity these will be redeemed as bond. Redeem means what? You will return the bond to the issuer and get the money. That process is called as redemption. That process is called as redemption. So these are issued as bond and upon maturity these will be redeemed as bonds. These are called as non-convertible. The best example are government bonds. The government bonds, whether these are issued by the state government or the central government, doesn't matter. These are issued as bonds and upon maturity they will mature as bond and your money will be returned to you if you are holding the instrument upon the maturity period. So the bonds can be convertible, the bonds can be non-convertible. Right? The bonds can be zero coupon as well. The bonds can be zero coupon instruments as well. What is this idea of a zero coupon instrument? Zero coupon instrument simply means when you are issuing the instrument I repeat, when you are issuing the instrument, whatever is the value written on the bond. Let's say there is a bond. Okay. Let's imagine here is a bond. Now on the bond, you have written 100 rupee. On the bond, the issuer has written printed 100 rupees. Now when you say 100 rupees, this is called as a face value. This is called as the face value. So when you have a bond with a face value, when you are issuing the instrument, you are not issuing at face value. What is a traditional practice? Traditional I am talking. The traditional practice is you will issue the bond, right, at 100 rupees because the face value is 100. And after 1 year, right, after 1 year, generally in 2 installments, the money is given by the government. After 1 year, if the interest rate on the bond is 6%, because you have borrowed means you will have to pay interest rate. So the government will pay interest rate on the face value of the bond. That is generally how the instruments are issued and the money is paid in a traditional sense. But in the context of the zero coupon, zero coupon means zero interest rate. The bond will have a face value of 100, but the bond now will be issued, let's say, at 90 rupees. The bond will be issued at 90 rupees. So face value is 100, issued at 90. This is basically issued at a discount. The bond has been issued at discount. And upon the maturity period, right, let's say 2 years, 3 years, whatever the duration is, upon the maturity period, whatever is the face value will be paid upon maturity period. The face value will be paid upon maturity period of the instrument. So these are such instruments which are issued at a zero coupon, which are issued at a discounted price. And upon maturity, you will receive the face value. These instruments are referred to as zero coupon instrument. And before I go forward, here is a very important point for you to note. Do not assume that, I repeat, do not assume that these instruments only are bonds. That is, zero coupon always are bonds. Not necessarily. Bonds can be issued in the form of zero coupon. And the short-term instruments can also be issued in the form of zero coupon. For example, the treasury bills. All of you remember the concept of a treasury bills that we discussed earlier. Treasury bills are the short-term instruments which are issued by the government of India, which will have a maturity period of up to 1 year. The treasury bills, when they are issued, if the face value of a treasury bill is 100 rupees, if the face value is 100 rupees, the government will issue it at 90 rupees. Will issue it at 95 rupees. Will issue it at, let's say, 93 rupees. And upon maturity, let's say 364 days, upon maturity, the face value of the treasury bill, that was 100 rupee, will be given to the investor. So before I go forward, please remember this. The zero coupon is a concept. It is associated with the bond also. It is associated with the short-term instruments as well. Okay, next, equity market. Let's shift to equity market now. What is equity? I've told you this. Equity simply represents shares. Equity market represents shares. Shares are units which represent ownership in a company. Right? I am repeating this. Shares are units which represent ownership in a company. So in the bond market, borrowing and lending happens. The issuer borrows money and repays it. Whereas in case of equity market, there is no concept of borrowing here. The shares are issued, that is, units representing ownership are issued. And because you are purchasing the shares, you are becoming the owner, one of the owners of the company. There is no concept of repayment or there is no concept of a liability on the company when, right, they will have to repay your money. Now you are the owner. And when you are the owner, if the company earns profits, I repeat, if the company earns profits, you will get part of the profits. And remember this, when the company earns profits and part of the profits are given to the shareholders, this particular profit which is distributed to the shareholders is called as dividend. This particular profit which is given to the shareholders, distributed amongst the shareholders, this is called as dividend. And when you talk about the equity market, when you talk about the bond market, who will regulate all of these markets? It is majorly regulated by Securities Exchange Board of India. Remember this? The bond market, equity market is regulated by Securities Exchange Board of India, SEBI, right, which was made a statutory authority. It was actually established in 1988, made a statutory authority with the SEBI Act in 1992. What about the money market? Majority of the money market is regulated by Reserve Bank of India. That is the main regulator. That doesn't mean there are that doesn't mean there are no other regulators. There are others. But the main regulator in the context of money market is RBI. In the capital market, it is Securities Exchange Board of India, SEBI. Now, the shares, when I talk about shares, the shares, there are two types. The shares, there are two types. One is called as a preference shares. One is called as a preference share. And the second one is an equity share. One is a preference share and the second one is equity share. What is a basic idea? What is the basic difference between both of them? A company will issue preference shares, the company will issue equity shares. The fundamental difference is, in case of the preference shareholder, if you have purchased the preference share, the dividend that will be given to you annually is fixed. Is the concept clear? I'll repeat it again. In case of the preference shares, the amount of dividend that is given to you annually is fixed. That is, let's say hypothetically, you have purchased a preference share of a company. The company annually, out of the profits that they make, they will give you 2 rupees. That amount is fixed. Whereas the equity shareholders, there is no guarantee how much will be the dividend given to them. In 1 year, it can become 50 paise. In second year, it can become 1 rupee. In the third year, it can be 3 rupee. In the fourth year, it can be 75 paise per share. So on one side, the preference shareholders will get a fixed amount of a dividend, whereas the equity shareholder, it will vary. Now somebody will simply look at this and say, it is better to become a preference shareholder then. It is always better to become a preference shareholder. One of the basic advantages of having preference shares is that you will get a fixed amount of dividend. But at the same point of time, when there are decisions made, when the decisions are supposed to be taken by the company, shareholders, they are the owners, by the way. They are the owners. So the shareholders will be asked to vote. Shareholders are asked to vote. So only those shareholders who are equity shareholders will have the voting power. Preference shareholders will not carry any kind of a voting power. Is the point clear? Right? If you basically say preference is much better, the problem with the preference shareholder is that they do not have a voting right. Equity shareholders, they have the voting right, but the amount of dividends that they will earn will vary from 1 year to another year compared to fixed amount of a dividend for a preference shareholder. Right? This is fundamentally the difference between a preference shareholder and an equity shareholder. Everybody is okay with this idea? Please do let me know. And when you talk about, let's say, issuance of the shares, once the company issues the shares, we call this particular company as a listed company. Once the company issues the shares, we call this company, this entity as a listed company. And what do you mean by listed company? Now the shares of the company are available in the market for trading purposes. These are available in the market for trading purposes. And what do I mean by trading purposes here? These are there in the stock market. You have heard of stock markets such as BSE, Bombay Stock Exchange, NSE, National Stock Exchange. These two are major national level stock exchanges in India. Major national level stock exchanges in India. Apart from these two, we have regional stock exchanges also, but these are very small in size, small in reach, etc. But BSE and NSE are the national level stock exchanges. So the shares of the company are there in the stock market. You can buy them, you can sell the shares. That is the meaning of a company when you say it is a listed company. Can we go forward now? Right, so these are the very important concepts I wanted to discuss with you people from this particular chapter on the capital market as well as the money market from the 12th class, right, the 12th standard book of Maharashtra Board. If you have any questions, do let me know. I'll address your questions, then we can close the session for today. Kaustav Chatterjee, sir, can normal people have preference shares? Yes, yes, right. Whenever the companies will issue these particular shares, anybody can purchase in the market. Any doubts? Please do let me know. Any doubts? Where commercial papers are traded, right? There's a market for that, right? There is a market, right? So in that particular market, the trading happens. And when I say market here, please understand, do not assume, right? Let's say the old concept where, right, there is a physical infrastructure, you will go, right, there will be different buyers, etc. No, right? So when you talk about the market, the trading of these instruments, etc., all of this is done virtually today. All of this is done virtually. BSE stands for Bombay Stock Exchange. BSE stands for Bombay Stock Exchange. NSE stands for National Stock Exchange. These are the two major exchanges in India. Done then. So that's it from my side. Take care. If you have liked the session, do not forget to hit the like button. If you're yet to join our YouTube channel, kindly do it right now. Before I close the session, here is a reminder. Tomorrow, I'm having one more session. We'll be covering the trade part, the chapter on trade, which is given in the 12th standard or the 12th class book of Indian economy of Maharashtra Board. That will happen tomorrow, sharp at 6 p.m. Do not miss out the session. See you all tomorrow, sharp at 6 p.m. Have a great day.